It's the 7th of May 2019, and in today's video we're going to take a look at the S&P 500. My name is David Hickson, and as always I must ask you to please make sure that you have read and understood these disclaimers before we take a look at the markets. Here is a chart of the S&P 500, and in today's video we're only going to be speaking about the trough analysis in this market. You might know that Sentient Trader is able to perform two separate analyses, a trough analysis and a peak analysis. However, according to Hurst's original definition of his cyclic theory, cycles in stock markets are synchronized at their troughs, and therefore the trough analysis is the more important one. There is some interesting information, I believe, to be gleaned from taking a look at a peak analysis, but for the sake of brevity and catching up with what's happening in this market, today we're going to be focusing only on the trough analysis. Now, I'm starting with this analysis because it is a very similar one to the one that we were looking at the end of 2018. In particular, you will notice that we have a 54-month cycle trough in February of 2016, and we had our most recent 18-month cycle trough over here in August of 2017. So that was the analysis situation at the end of 2018, and at that time we were expecting an 18-month cycle trough to form in the markets. So in fact, let's take a look at exactly when we were expecting that 18-month cycle trough to form. We were, of course, measuring forward from the 18-month cycle trough in August of 2017, and 546 days is the average length of an 18-month cycle, and so we would have expected a trough to form in about the middle of February of this year. If we measure forward from the 54-month cycle trough in February of 2016, then of course we measure forward 1,092 days, and that would have brought us to about the beginning of February of this year. So that is the exact time at which we would have expected the 18-month cycle trough to form, early to mid-February of 2019. Of course, because of the principle of variation, we know that the wavelengths of these cycles are constantly varying. The markets are dynamic. And so we are standing by before an important trough, such as the trough of the 18-month cycle, because that trough could occur early or it could occur late. As it happened, and it's really clear to see now, of course, on this chart, the 18-month cycle trough did occur right at the end of 2018, round about Christmas. Okay, so with the benefit of some hindsight, we can now say that was definitely the trough of the 18-month cycle that we were expecting. However, was it only a trough of the 18-month cycle? What I mean by that is, could it be a trough of a longer cycle as well? Because, of course, the cycles are synchronized at their troughs. And so when a trough forms, we can generally look at that trough and we can say that is at least a trough of a particular magnitude, in this case 18 months. I have no doubt that that is at least a trough of 18 months, but it might also be a trough of a longer cycle. So I'm not going to spend too long looking at all the different possibilities. This first chart that I've chosen to show you is a really interesting one, because you will see this floating diamond over here. Now, according to Hurst cyclic theory, or at least the original definition of that theory, you can't have floating diamonds. So what is going on here? Well, I'm extending the ideas that Hurst originally defined, and I have applied an interesting cycle to this particular chart, which is a 6-year cycle. No such cycle was found by Hurst, but I believe that there is the possibility that such a cycle actually exists. Now, of course, in many ways, a 6-year cycle is really just an harmonic echo of the other cycles, because we know there is an 18-month cycle, and of course 4 18-month cycles would make up a 6-year cycle. And so there might not actually be a 6-year cycle. It is simply something that occurs every 4 18 months. And so it's a questionable concept, but it's a really interesting one to look at, in my opinion. So let's zoom out on this chart and take a look at how this 6-year cycle actually plays out. One of the interesting features about this analysis is that, of course, we have a really big trough here in 2002. We have the other one in 2009. And then we have this big trough in 2016. Those are really the prominent troughs that we are seeing on this chart. And the recent trough here at the end of December 2018 is very much as prominent, if not more so, than those other prominent troughs in this market. And so, of course, it might only be an 18-month cycle. But if you have a look at the analysis at the foot of this chart, you will see where the 6-year cycles have also been marked. And so it's an interesting idea that it is also a trough of the 6-year cycle. Let's take a look at some other possibilities. Here is a different analysis of the same data or the same market, and you can see that the 2009 trough in this particular analysis has been marked as a trough of the 9-year cycle. And then the 2016 trough has been marked as the next trough of the 9-year cycle. And here, the recent trough in December of 2018 has been marked as a trough of the 54-month cycle. So how is that possible? How is it so different? Well, it's possible because I've applied a different nominal model. In other words, I'm using a different list of cycles. So I've just spoken about the 9-year cycle and the 54-month cycle. But in fact, in this analysis, those cycles are shorter, and they are roughly 7 years and 40 months each. So this also provides us with a valid analysis, in my opinion. And the magnitude of the December trough is now a magnitude of 54 months or 40 months, according to the nominal model of this chart. Now, I really do not want to confuse you. I know I'm throwing quite a lot of numbers and time periods and that kind of thing around. For now, just focus on the concept that on the other chart, there was a yellow diamond beneath the Christmas 2018 trough, and on this chart, there's an orange diamond. In other words, it is of a greater magnitude. It's a more important trough. Let's have a look at a third possibility, which is shown on this chart here. Again, we have a very prominent trough. In this case, it's actually an 18-year cycle trough in 2009, and the December 2018 trough is marked as a trough of the 9-year cycle. And so clearly that trough in December is an important trough. We can see from the price movement that has followed it that it was an important trough. So what magnitude was that trough? Well, before I actually answer that question, I'd like to point out a few details about this analysis in particular. Phasing that trough as a 9-year cycle trough is perfectly possible and valid. It's a fairly good analysis. However, there are some fairly big question marks around this analysis, in particular the position of the 54-month cycle over here. I think that's 2014. That's a really big question mark because a 54-month cycle trough should be a fairly big, important trough, such as we saw in the year 2016. To position that 54-month cycle trough beneath this trough in 2014 is questionable. And so, although this 9-year cycle looks very encouraging in December of 2018, there are some question marks surrounding this analysis. I'm often asked, which is the correct analysis? People who are new to Hurst Cycles and new users of Sentient Trader often send us charts and ask, which is the correct analysis? I'm looking at 2 different analyses. And my answer might surprise you. I believe it's very difficult to say with absolute certainty which is the correct analysis. I think if you're asking yourself which is the correct analysis, you might be asking the wrong question. The question that you should be asking, in my opinion, is what is my level of confidence in a particular analysis? So looking at this analysis, and let's clear these markings, looking at this analysis, my level of confidence is not at the 9-year level, because in my opinion it's too soon to say with confidence that that is a 9-year trough. Now it might be a 9-year cycle trough, but we cannot say that with confidence yet. We also cannot say with confidence that the 54-month cycle trough is correctly placed there, and therefore our confidence in this analysis is not even at the 54-month cycle level. However, if we take a look at the 18-month cycle troughs that have been marked on the chart, I think you can say with some degree of confidence that those troughs are all of at least 18-month magnitude. In other words, my level of confidence in this analysis is 18 months. And without going through all of the other charts in detail, I can tell you that my level of confidence in all of these analyses is at about the 18-month level. When the big peak formed in January of 2018, I mentioned in most of the videos that I recorded about that peak that my level of confidence in that peak was at 18 months. Potentially it could have been a 9-year peak. Yes, it could have been, and it might still turn out to have been a 9-year peak, because it is possible that price will exceed that peak. Hurst Cycles does not have rules like Elliott Wave, where you cannot exceed the level of a peak or a trough, although it is unusual. And the formation of peaks in stock markets is a very complex affair. You will often end up with multiple peaks, which eventually form the final expected peak of 9-year magnitude or whatever it is. But I spoke about that peak as being of at least 18-month magnitude. And I'm doing the same about this trough that formed in December of 2018. It might have been, as you can see from this analysis, a 9-year cycle trough. It might have been a 54-month cycle trough. It might have been a 40-month cycle trough if you think that nominal model works for you. But in my opinion, it was at least an 18-month cycle trough. So the question is, what do we expect next? In order to consider what we are expecting next, I'm going to come back to the analysis that I favor. This is the one that I think really works the best out of all of them. You might choose a different analysis. Again, as I've mentioned, I don't believe it's possible to say at this stage or at any stage which is the correct analysis without any doubt, but I do think that this analysis looks really pretty good. So what I'm going to do is zoom in, and the first thing I'm going to do is try to understand what the analysis is telling me to expect. And a very useful way of doing that is to put up the composite model line. This line shows us the summary, if you like, in the past of the cycle analysis that you are seeing at the foot of the chart. And this composite model line is based only upon the trough analysis that we're looking at. So there is no peak analysis mixed into this composite model line. And so the software is taking the cycle analysis in the past and it's recomposing the price movement out of the cycle information. And this dashed orange line is the line that results from recomposing that information. And it then extends that line into the future on the presumption that the cycles are going to keep beating with the same wavelength and the same amplitude, which of course is something we know is not going to happen. Because of the principle of variation, the wavelengths and the amplitudes of the cycles are undoubtedly going to change. Nevertheless, it gives us an idea of roughly what to expect. And so you can see the composite model line is telling us that the market is about to form a peak. In fact, the exact peak of the composite model line still lies ahead of us, still lies about a month ahead of us. I think we'll take a look at it in more detail in a moment. And then the market's going to turn down, bounce back up again, as it does, of course, and then turn down again. So over the next year or so, that's pretty much the movement that we're expecting on the basis of this trough analysis. So let's zoom in and take a look at what to expect in the shorter term. And here we can see the same composite model line. Perhaps I could, at this zoom scale, add just a little more detail. You can see that the composite model line is telling us to expect a bit of a peak here. Then the market's going to move down. It's going to move down to what? Well, here is the nest of lows for the 20-week cycle. So the market is expected to move down and form a 20-week cycle trough, after which it will bounce back up again. Of course, it'll then form another higher peak, which could be either one of these peaks here, so either early June or late June, and then the market is going to turn down and come down into this 40-week cycle trough over here. That's a rough overview of what this analysis is telling us to expect. And of course, we're only looking at troughs. We haven't even got to looking at peaks yet, but we're going to stick with troughs in today's video, as I've mentioned. So let's zoom in a little further and speak about this in a bit more detail. Let's discard the composite model line. The composite model line is very useful for helping us to understand the implications of an analysis. You should never expect the market to follow that line as an absolute projection. That's bound to end in disappointment, and the reason for that is because of the principle of variation, of course. Cycles are going to vary. The important point is our expectation. So our expectation right now is that some kind of a peak is forming, or has formed perhaps, in the market, and this market is expected to move downwards and form this 20-week cycle trough. So here you can see the nest of lows for the 20-week cycle trough. So the next big event, if you like, in cycle terms in this market is going to be the formation of the 20-week cycle trough. Now, I treat these triangles that form around the nests of lows where all the cycles are synchronized a little bit like triangular objects, and I calculate a sort of a center of gravity. And the center of gravity of this triangle is probably somewhere over there. Bear in mind this circle for the 20-week cycle is already behind us, and so that's pulling the center of gravity to the left a little bit. So I am expecting to see a 20-week cycle trough forming perhaps sometime this week or maybe next week. Certainly it's expected fairly soon. So that's in terms of time. We're expecting the market to form a 20-week cycle trough within the next week or two. Because it's 20 weeks, we need to give it a little bit of breathing room, but that's certainly what we are expecting to happen next, is a 20-week cycle trough. Where might it form? Because Hurst Cycles can give us information about the timing of turns in the market, but it can also give us very useful information about levels at which turns might occur. And of course, I use my favorite tool, the future line of demarcation, or FLD for short. And this is the FLD for the 80-day cycle. And the reason why I'm showing you this FLD is because I believe it's going to play an important role in the formation of the 20-week cycle trough. Now, there's a sequence of interactions that occur between price and any FLD, and that same sequence occurs with the 80-day FLD. And so the way this works is following the trough of a cycle of at least 3 degrees longer, which, if this is an 18-month cycle trough, this certainly is. Price will then move from that trough up to the point at which the FLD is crossed, which is about over there. So let's just get some price levels and measure that. The low at this particular point on this bar is about 23.40, and the level at which price crossed the FLD, and it was a slightly messy cross, as it very often is. FLDs are very important lines, and they often cause price to pause and hesitate and bounce back and forth. But a rough crossing level of that line is at about 26.45. 23.40 to 26.45 gives us a projection that we can calculate, because we expect price to extend an equal distance beyond the FLD, equal to the distance that it traveled before it crossed the FLD. So from 23.40 to 26.45 is 305 points. Add 305 points onto 26.45 and we get 29.50. And there is a line at 29.50. The target from the move up to the 80-day FLD was achieved. Now, as you can see, price did achieve that target. It went perhaps a few points over that target, but that target was fulfilled. So we have a good interaction between price and the 80-day FLD. What are some of the other things that we expect? Well, having crossed the FLD over here, that's a price cross, and we call that an A category interaction. price at around about the time of the first trough of the cycle upon which the FLD is based, in this case the 80-day cycle, is expected to come down towards the FLD, find support at the FLD, and then bounce upwards. Now, it didn't find support at the FLD. There was a good gap of about 50 points between the FLD and price, at which it found support, at which price found support. So what's going on there? What's going on is that there is clearly a lot of bullish momentum. The underlying trend is very bullish, and so instead of price coming down and finding support at the 80-day FLD, it found support above the 80-day FLD, indicating good bullishness in that market. So now, why are we looking at the 80-day FLD? Well, because this move down towards the FLD is the B category interaction, the bounce up is the C category interaction, and the next interaction is the D category interaction. So what we're expecting next is for price to come down to the 80-day FLD, at which point we would expect it to cross down below that FLD and then generate a target to the downside equal to the move down to the point at which it crosses, and we would expect that target to be fulfilled. And that target would be fulfilled at the 20-week cycle trough, which of course we are expecting in the next few weeks. So now we have a target, or I should say we don't have a target yet, but once price crosses the 80-day FLD, we will have a target. But bear in mind the strong bullishness that was revealed by the fact that the B category interaction didn't even reach down to that FLD. That means that if that bullishness is still alive and well in the market, and there is no reason to suspect that it isn't, then we might not find that price comes all the way down to reach this target. So the first level that I'm going to be watching is the 80-day FLD. If price finds support at the level of the 80-day FLD, that would be a fairly reasonable thing to happen. But if price crosses below the 80-day FLD, we would expect it to move towards that target, even if it doesn't quite achieve it, on its way to forming the 20-week cycle trough. I do hope that you found this market update interesting. In future videos, I will be taking a look at the peak analysis as well. We're in a very interesting situation at the moment where a really big peak is forming, in my opinion, in the financial markets, and it's a complicated peak, of course, as peaks always are in stock markets, but it's going to be very interesting to track how that peak forms. If you have any questions, please post them below this video or send us an email, info@sentienttrader or info@hurstcycles.com.